Weekly inflation outlook. The tide is coming in. Hi YouTube, watch this video. Thursday, existing home sales report threw into stark relief with a pertinent example, exactly what I have been talking about recently. Growth doesn't cause inflation, and recession don't cause disinflation. So, while I am negative on the outlook for growth, I don't expect there will be any help in cooling the virus of inflation. The existing home sales report last week was disappointing, confirming the justified fears of home builders and realtors that higher mortgage rates and a slowing economy would better traffic and turnover. By now, you know that home sales rose at a 5.61 mm seasonally adjusted annual rate, which was lower than expectations and the lowest since the months of the pandemic shutdown. While that would still be a relatively healthy rate compared with the pre-COVID era, there is no question that the increase in interest rates is slowing turnover. This effect is one of the more obvious ways that higher interest rates cause a slowdown in economic activity, and it's clearly an outcome that's it. Intended by the Federal Reserve, slow down the red-hot housing market and cool the inflation in housing prices. Well, one of two ain't bad. April's increase in home prices was plus 4.38% month over month, keeping the YoY figure at plus 14.8%. Now, prices in the housing market are highly seasonal, but still April 2005 and April 2013 were the only years this century when the MRM gains in April were higher. The first those year was when the housing bubble was inflating. The second was when they were bouncing after the bubble collapsed. The following chart from Bloomberg shows the MRM change by calendar month for the last 4 years. The thin blue line up top is the April MRM gain. So while home sales were weak, home price increases remain very strong. Surely they cannot continue at 15 or until 20% per year. But the important point is that the connection between home sales and home prices is tenuous at best. In housing, there are at least two reasons for this, and week one, uh, sorry, and one of them applies the market in general. The first reason, to which I alluded last week, is that the first impact of higher mortgage rates is on the more price-sensitive buyers. But the bigger reason is that as long as the overall price level itself continues to increase rapidly, the nominal price of any fixed asset should keep increasing as well. The price level is changing. A 14% Y increase in home price when inflation is at 8% is the same in the real terms is an 8% increase when inflation is at 2%. Thank you for watching. See you in the next video. Bye bye.